Hi, everyone. Happy Friday, wherever you are in the world, and welcome to another FP Insider conference call on emerging markets and the coronavirus. I'm Ravi Agrawal, Managing Editor of Foreign Policy and your host for the next 40 minutes. Today, we're going to explore the pandemic's impact on emerging markets. While the coronavirus so far has been deadliest in the United States and in Western Europe, emerging economies across Asia, Latin America, and Africa are bracing not only for healthcare crises, but also for capital outflows, fiscal crises, and maybe even government defaults. So how bad will things get? What steps can governments take to safeguard their economies? How will private sectors cope? We're going to go over those and other questions with two real expert guests today. But before I introduce them, a few quick housekeeping notes. If you're joining us on Zoom, enjoy the show, ask questions. There's a Q&A button at the bottom of your app. Click on it, send in your question, tell us who you are, where you're from, and who you're directing the question at, and I'll try and bring it into the conversation. If you're watching us on YouTube, email us at web@foreignpolicy.com. It's very simple. So let's get started. I'm excited to welcome our two terrific speakers, and I'm going to ask them now to turn their cameras on and to unmute themselves. Ruchir Sharma is head of emerging markets and chief global strategist at Morgan Stanley. He's written several excellent books, including Breakout Nations and his latest 10 Rules of Successful Nations. And we also have Dambisa Moyo, an economist who's worked at the World Bank and at Goldman Sachs. She's the author of books such as Dead Aid and The Edge of Chaos. She's also on the boards of 3M, Chevron, and Barclays Bank. Welcome to both of you. So, Ruchir, let me start with you. When it comes to emerging markets,
thank you very much.
Hi, Ruchir. I'm going to start with you. When it comes to emerging markets, how do you compare the current moment to past crises such as 2008 or the Asian financial crisis? How bad will this time get?
Well, in terms of economic contraction, this is going to be the worst, pretty much as it is for the global economy, that this is going to be the worst contraction for emerging markets since the Second World War, since the Great Depression, really. So in economic terms, it is absolutely devastating for emerging markets. The sad part here is that from a health perspective, the pandemic is less catastrophic for the emerging world than it is for the developed world. And there are a few statistics which sort of bear this out, at least so far, that if you look at the fertility rates of the top 20 nations in the world, so far there's only one emerging market that features in the top 20, and that is Iran. All the other 19 are developed countries. Generally, if you look at the fertility rates, the incidence of this virus in the developing world has been about 4 to 5 times less compared to what has happened in the developed world. The reason why that's happened, we still don't know. Maybe it's early, but if you just look at the various factors, I think a combination of a multitude of factors, since we don't know enough, we can only make some guesses based on the empirical evidence, is a combination of heat, sunlight, possibly BCG vaccinations, demographics, and even lower urbanization. It may have, in fact, helped contain this virus more in the developing world compared to the richer nations. The unfortunate bit, though, is that in economic and financial terms, the emerging markets are as, if not more, devastated than what the developed world is seeing in terms of the economic impact. And that is partly also because the ability of these emerging markets to stimulate is not as great as what you have in the developed world. They're still very dependent on dollar funding, very dependent on capital inflows, also much greater share of exports in the global economy. And I think it's also because some countries have felt compelled to impose pretty stringent lockdown measures on their nations, even though they don't have very well-functioning welfare states. You don't have people on unemployment benefits in many of these countries. So I think that it, yeah.
And
so
Ruchir, it's fair then to say that in these developing economies, which have large groups of people, large percentages of people who are informal workers, then that they would suffer even more given in a lockdown scenario.
Yeah, that's the big difference with 2008, 2009. Because in 2008, 2009, when the crisis hit, it was very much something which hit the formal sectors of these economies. And in the informal sector, we didn't see that much of an impact. But subsequently, when the commodity boom went bust, that's when you began to see the big impact in those countries. But otherwise, the 2008, 2009 crisis was very different in terms of what we saw. So I think that is really how to sum it up as far as the emerging world is concerned, which is that this is, in health terms, so far, it's not been as catastrophic as has been the case in the developed world. But in economic and financial terms, it's been almost as catastrophic, if not more. For example, the stock markets in the emerging world, on average, they're down about 20% this year. The US stock market is down barely 10%. So that just tells you about how this is playing out very differently economically and financially in the emerging world, even though from a health perspective, the results are different.
And I should point out, in dollar terms, emerging market economies, stock markets were already underperforming compared to, say, the S&P 500 in the US. So
yes,
that's even more exacerbated. I want to bring Dambisa in, and as I do so, I'd like to draw our viewers' attention to the screen now, where you're going to see a chart from The Economist, which looks at 66 emerging markets ranked on measures of financial strength, public and foreign debt, reserves, so on. And you'll see that the likes of Botswana, Taiwan, and South Korea rank top. Dambisa, I want to get your comments on the ones at the bottom, because we're all worried about what could happen to them. So Lebanon, Venezuela, but also Zambia, your home country. What's the prognosis for those countries?
So you just touched on a very key point a moment ago that I think is really important to set up the backdrop of what we're dealing with, which is to say, even before the coronavirus hit, many countries were already struggling. They were struggling in terms of economic growth, in terms of top line economic growth. And by that, I mean, the growth rates were far below the rates of growth that we need to see in order to double per capita incomes in a generation. So if you just look at the rule of 72, really countries should be growing at least 3%. For very poor countries, they should be growing much faster if you want to double per capita incomes in a generation. We were already seeing low and slow growth in the emerging markets. But coupled with that, countries that you've just touched on were already struggling to pay back debt. Their maturities were extremely short. And what you've seen from the coronavirus is an exacerbation or the speeding up of what I would call an option expiry into a much more challenging environment where their top line growth is low. They have high costs in terms of the debt that they owe in secondary markets, primarily to China. And also now we're seeing a real contraction in terms of the commodity markets, and many of the countries, the two of the three at least, Zambia and Venezuela, countries that are commodity exporters, but many other commodity exporters are struggling in this environment. So I think that confluence of factors, low growth, high costs in terms of the debt, coupled with the fact that it's short-term debt and the fact that they're commodity exporters is really a very, very challenging mix.
Ruchir, you use your own set of rules to rank countries, which you outlined in 10 Rules of Successful Nations. Give us a taste of what you're looking at, and by your metrics, which countries might be worst off.
Right. So I think that the good news here is this, which is that that the countries which are really in serious financial trouble are some very small countries. Whether it's got to do with countries in Africa, countries in Latin America, some of the very small countries are the ones which are in serious financial trouble. The larger emerging markets have more of a growth problem, which is that they don't quite know in terms of what the new growth engine could be, because the old growth model of exporting your prosperity, which is how many countries such as Korea, Taiwan, China, Singapore were able to graduate from the emerging world to the developed world or near there in terms of at least high middle income countries, that model has gone dead. So the good news is that I don't foresee at least a major financial accident in some of the larger emerging countries. And by larger, I mean the top 20 or 25 emerging countries. The world has 200 odd nations there. 40 of those are classified as developed nations, but the balance, 160 or so, are classified as emerging, and many of them have been emerging forever. So it's not that sort of surprising to see them go through these cycles as far as things are concerned. So what our work is basically showing at this point is that it has already been a very rough spell for emerging markets. The emerging markets, stock markets, for example, they are still down about 25 to 30% compared to their 2007 highs in dollar terms. It's been the worst decade for investing in emerging market stocks over the last decade. So when I wrote my first book, my basic sort of thesis in that, of breakout nations, was that these BRICS are way overhyped. The commodity boom is way overdone. That is what I was saying a decade ago. And that the real breakout nation in the world was United States with its technological prowess. I wish I had invested more along those lines, but here I am a decade later. And a decade later, I find that it's very different, that these emerging markets are badly beaten down. We all want to sort of turn very negative on them, and we're losing perspective here in terms of what could be a risk-reward ratio from here onwards. So what our rules framework is showing is that some of the larger emerging markets, including places such as Brazil and Russia, that I was so negative on when I wrote Breakout Nations a decade ago, are looking interesting now from an investing perspective. Their currencies are super cheap and super competitive. Sentiment is very negative. Those are the kind of metrics we look at in terms of figuring out which emerging markets could sort of break out or at least do well. And I think that is what we have to put in perspective as far as emerging markets are concerned. That a decade ago, we were all extrapolating on how emerging markets were going to rule the world, and this was going to be an Asian century, and this was going to be an African century. That was the narrative a decade ago. But the long history of emerging markets is that they go through cycles of 5 and 10 years. That you get a boom and then you get a bust, and many of them don't go anywhere for a long period of time. Most countries in Africa and Latin America have not been able to catch up to the United States for 100 years. Brazil, Mexico, these countries are as poor compared to the United States as they were 100 years ago in terms of per capita income. So the point I'm making is in the next 5 or 10 years could be that we could be setting up the base here for the next 5 or 10 years to be better.
Ruchir, I'm going to bring in Dambisa on this because you're doubling down on the United States. Dambisa, go ahead.
Sorry,
I know because you worked on the BRICS team at Goldman Sachs.
Well, so my view is quite different. If you look at the statistics that the forecast the IMF has put out recently, specifically on Brazil and Russia, which Ruchir just mentioned, the forecasts have gone from actual data for Brazil of 1.1. It's now being forecasted at minus 5.3. Russia, 1.3 2019 in terms of growth, the forecast minus 5.5. So, I've always been an enthusiast in terms of just fundamental growth strictures. If you look at capital, if you look at labor, if you look at productivity, there was always a narrative that these 3 key engines of growth were particularly compelling for the emerging markets. They had relatively low debt and not very significant deficits. I'm talking about the last decade. In terms of labor markets, both in terms of the quality and the quantity of the labor markets, it was a very compelling story. They're young markets and significant proportion of the population. As you know, emerging markets are 90% of the world's population. And in terms of productivity, their ability to really transform and to import technologies and both in terms of rule of law, but also technology in the traditional sense to spur economic growth was very compelling. That has not happened. I would love to be, and like Ruchir, have actually got burned myself in terms of being an investor in the emerging markets. I just think in this type of a situation where you do need deep pockets to stem the challenges that you're facing in the health sector, which Ruchir touched on, but as well as the ability to stimulate the economies and to protect the economies on the downside, I can't see how you wouldn't be pro or supportive more of a place like the United States over the emerging markets. I think the story is much more complicated in the emerging markets, and of course we're using shorthand here because there's so many differences, but the fact that they're so heavily dependent on exports and specifically in commodity markets in general, to me makes it a much more challenged story and also very discourages me quite considerably from dipping my toe into the emerging markets, unfortunately.
Dambisa, you wrote an article for The Economist last week in which you argued that Africa needs a modern Marshall Plan of sorts. But you, of course, have in the past criticized the very idea of large-scale foreign aid programs. So why is it that the coronavirus has changed your mind?
Well, my mind hasn't been changed. And I was very clear in the article that to say that it hasn't changed. I think we have to make a clear delineation between large systemic aid packages of the sorts that come from the World Bank and IMF, just to support economies on a general basis. That was what I was criticizing. I was saying those are very corrosive in terms of corruption, but also in terms of undermining government efficacy. The Marshall Plan was a humanitarian, or what I would describe as an emergency package. And that's what I was advocating for. Something that's short, sharp, and finite, not an open-ended, in perpetuity type of aid program. African countries, by and large, absolutely need that support. As you probably know, the World Health Organization suggests that countries should have roughly $35 to $40 per capita per annum on healthcare spend for their populations. Many African countries cannot even do that. I mean, think about it. They cannot pony up $40 a year for their citizens to cover healthcare. So it's very dire straits. And the argument I was making very quickly here was just to say that there was obviously a moral claim, a moral issue in terms of us helping fellow citizens, but there's a broader context for Western society to step in, which is to say, look, you don't want to have disorderly migration. And a diseases, it's a global public good issue now, as opposed to it being just an African issue. So, it may seem fanciful. The IMF and the World Bank together have pledged $62 billion globally, but specifically for emerging markets, I should say, to try and fend off the effects of coronavirus. We've seen the head of the IMF come out recently to say that we need about $2.5 trillion for emerging markets to deal with the fallout. And I'm inclined to agree. I mean, but as I said, it may seem a bit fanciful given the debts and deficits and the economic growth picture in the West anyway.
Ruchir, I want to bring you in here because, on the point of ammunition from the IMF, and I want to pull up another chart which shows that since the 2008 financial crisis, at which time the IMF and the World Bank were the biggest creditors to the developing world, but that's really sort of changed in recent years because China has taken over now as the dominant creditor of sorts to the developing world. So my first question, Ruchir, is do you think that there are enough safeguards in the international system to help emerging markets if they need that help? B, is China's role now going to be very crucial in that process?
Right. So again, I think that the real help is required of nations that make a long tail. I don't think that any of the big nations as of now require any major help. So the top 20 emerging nations by GDP, I don't think any of them require any help. So it's a very long tail of other countries on the smaller size, which really require help out here. So, in that way, this is a chain situation, which is that these large emerging markets, they're not that dependent anymore on financing their debt externally. In fact, a lot of the debt that they've issued has been in local currency terms. So that's a big change which has taken place. So I think that the problem is this, that a lot of the narrative, a lot of discussion about emerging markets is being skewed a lot these days by these smaller nations and the stress that they are facing on the financing side. As I said, the bigger problem in emerging nations remains the growth model is sort of broken, the exporting away to prosperity model. The reason I'm a bit more sort of feeling like a bit more sanguine about emerging markets is because having done this for such a long period of time, I think that they go through cycles. The same people today who are bearish on emerging markets were having arguments, with me a decade ago on Breakout Nations when I wrote about why emerging markets was the place to be and the US was the nation not to be in. And now it's flipped. And I've, been a big fan of the US over the last decade. In fact, my most recent essay was about how the US is the comeback nation. That it always defies the critics. It's able to do much better than we think. But I think that as an investor today, when I wear that hat on, I think very differently today, because you always invest in emerging markets when things look really bad, when you're at peak pessimism, when currencies have gotten slaughtered. That's what happened in the late 1990s as well. That's when you sort of do that. And also here's one upside to this crisis too, which is that emerging markets only tend to reform when they have their back to the wall. One of the rules that I've spoken about in the past, my political rule, is the circle of life rule, which is that emerging markets follow 4 stages in a circle of life and keep going round and round on those, and therefore remain emerging forever, which is that they reform when there's a crisis. The reforms after the crisis lead to some sort of a growth spurt, which leads to complacency, and that complacency then sows the seeds again for another crisis.
So Ruchir, let me push you on that, because the classic example of what you're describing is India, a country that has long flattered to deceive, a country that only managed to put in place tough reforms after a fiscal crisis in '91, and that finds itself in another sort of pre-coronavirus slowdown. I have a question from an Indian listener, Vijay Karthik, and he's in India, and his question is that why is the Indian stock market not taking the pain on Main Street into account in the last couple of months? Is this sort of, cognitive dissonance of sorts? Is it a delay, or is it a wider recognition that this won't be so bad?
No, I think that this is a global issue. So the Indian stock market's performance is highly correlated to global markets. In fact, if I show you a chart of the Indian stock market and global markets, particularly emerging markets, you won't be able to tell the difference. So the two tend to move in lockstep. I think that this is an issue that we're grappling everywhere, that even in the US, many sort of fundamental investors can't wrap their head around the fact that, for example, in the month of April, you had the best stock market rally on record in recent times, even though the economy there had its worst month possibly since the Great Depression. So I think that this is a global phenomenon, which is that there's so much liquidity, so much stimulus being pumped out by the various governments and central banks around the world, that a lot of it is finding its way into the stock market, not just in India, but across the world. So the Indian stock market this year in dollar terms is down 20%. Guess what? How much the average emerging market is down this year? 20%. So it's very much the same story. And the US is, as I said, down around 10% or so, barely. So I think that this epic battle is going on around the world between the stock markets and between the economy because of liquidity. There's so much liquidity out there. And that also explains why the Indian stock market, that always takes its cue from the global stock markets, has done much, has not done as badly as the pain that your listener is describing that's happening on Main Street. So this Wall Street, mainstream dichotomy is universal, not just in India.
Fair enough. I have a question on email from Antoine van Agtmael. He's a senior advisor to FP. He's also the man who coined the phrase emerging markets several years ago. So it's very apt that we're taking a question from him. And he's asking, Dambisa, I'm going to put this to you, whether the coronavirus pandemic will lead to the end of the export-led model of economic development in emerging markets. And I guess what he's riffing on here is supply chains being disrupted and then being reformed in the next 3 or 4 years.
Well, I think that, so here I kind of have a bit of schizophrenia, because I think from the corporate side, what we've realized is that there clearly has been a shift in the discussion from seeking efficiencies and cost arguments for having global supply chains into a world now where corporations are really very focused on robustness, resilience, making sure that they are battle ready when we have, as we are now, face a pandemic. My sense is that that shift was already occurring in many different ways. And I should say, but when I say that shift, I mean the shift towards a more deglobalized world, not just in terms of supply chains, but also in terms of thinking about deployment of labor, but also one of the big issues now is around this idea of the splinter net, this idea that there could be two technology platforms, a Chinese one versus a US or Western-led one, and that companies were already starting to think about whether they can operate as sort of pseudo-global companies in a world that is becoming much more balkanized and fragmented. So in short, I do think, as I intimated earlier, that the coronavirus is actually expediting or catalyzing a lot of trends that were already in train. And so, whether it's about concerns about Congressional Budget Office, the concerns that they've expressed around debts and deficits in Europe and the United States, but also issues around debt that we talked about, geopolitical fragmentation and balkanization around supply chains and around the splinter net. I think all those things are things we thought were going to be problematic in 10 years. What the coronavirus has done is to basically say, actually, no, they are a problem today that we need to address.
And on that point, I just want to plug Foreign Policy's Power Maps. We have a new one on data governance, which I'd really urge you to read on foreignpolicy.com/power maps. We're getting lots more questions from our viewers around the world. I have one from the University of Copenhagen. This is Ravinder Kaur, and I'm going to put it to Ruchir. And Ruchir, she's asking you that the investment model that worked for many emerging markets the past couple of decades seems to have run out of steam. These are her words, not mine. And given the ongoing move toward trade restrictions, what future models do you see for emerging markets?
Yeah, so I think that she's totally right, that we are in a world of deglobalization. As that was my previous New York Times piece about how the trends are being accelerated and that the world is going to be left more deglobalized, dataphobic, and digitized. So that's what's going to happen. So I think that the focus is shifting much more towards regionalization and on catering more to the domestic markets. What this means is that the sort of growth rates that countries were able to achieve, the 8-9% type of growth rates, those only happened in this era between 1950 and 2008, mainly because countries were able to export their way to prosperity. So that model is dead. I agree with that. And I think that, but it doesn't mean that growth need be dead completely. It just means the fact that you will not be able to grow at those rates, but you have to now focus much more on your domestic markets and sort of unleashing the entrepreneurial spirit in your domestic markets to try and get to growth rates which are still respectable, but not at that breakneck pace. I think that we were so spoiled in terms of our benchmarks because of this exceptional era that we had, especially in the 2000s, that everyone's sort of benchmarks went up a lot. There were so many countries growing at the 7-8% type of growth rates. And then even stretching back further, the global economy's growth rates between 1950 and 2008 were exceptionally high because we had a demographic boom, we had a globalization boom, and we had a debt super cycle. So a lot of these things have changed now, and we need to sort of lower our expectations for what we think is the benchmark for economic success. We can't keep using the old models as the benchmark for economic success. And once we lower the model, I think that we'll end up with a somewhat sort of better, more sanguine view of the world than it seems today. The problem today is a lot of anchoring bias that we were so used to seeing countries explode and grow at 8-9% like they did. I think there were 40 odd countries in the world which were growing above 7%, 40 odd countries in 2007 or so. Now, even before this virus last year, that number had dwindled to about 7-8 countries, and those are all in small like African countries where we didn't even know what the real growth rate is. So I think the benchmark for success has to be lowered everywhere. That is the result of this deglobalized world, but it's not the end of the world. It is just a lower benchmark for success.
Sure.
Ravi, can I just add on very
one of the
quickly? The other thing that's changed.
Yes.
Sorry, I was just going to say very quickly, the other thing that's changed, I talk about this in my book, Edge of Chaos, is that we've got a lot of headwinds. Some of them actually used to be tailwinds. So demographics is one of them that Ruchir just mentioned, but there are a lot of headwinds that we had not experienced in the period between 1950 and 2008, such as technology, the technology boom and the risk of a jobless underclass, the concerns around income inequality, real issues around climate change. I mean, these are things that costs that we did not fully ascribe into the debate that are now real costs, heavily costed headwinds that the economy, the global economy has to deal with.
I think that's a fair point, Dambisa. And I was going to say something similar in that obviously the metrics Ruchir is looking at are, larger sort of national metrics. But of course, there's so many other indicators of social well-being, inequality, et cetera, which policymakers tend to use when they look at outcomes. I have another question. This one's for Dambisa from Fareed Khan, who's asking what should MDBs or the multilateral development banks focus their funding on? Should it be large infrastructure projects of national and regional significance, as you've mentioned in your book, Dambisa, or in these most exceptional of circumstances, should it be to just provide relief financing to fund emergency medical supplies?
Well, I think that, as I mentioned earlier, there's definitely an urgent need now today. We are in, and it's a separation between the urgent versus important, if I can use the cliche. So for me, what I think is most urgent is keeping people alive and stabilizing, as we've done in the United States and other places. I mean, we've had helicopter money in Hong Kong. We've had checks written out here in the United States and also across Europe. There have been lots of interventions, really not to stimulate these economies, but to stabilize these economies. And in much the same way, we want to ensure that we are stabilizing the emerging markets. Ruchir is right to note that we have not yet seen the sort of large scale healthcare concerns that we're seeing in the West. For my own druthers, I actually think it's a timing issue. I actually have an undergraduate degree in chemistry, and so I am interested in the science aspects. I'm not here as a scientist, but nevertheless, I do think that we could see a considerable spike once the temperature starts to cool off, which is really starting in June in the Southern Hemisphere. And we've already seen some spikes in Brazil already. So I'm taking a much less sanguine view about what the healthcare considerations will be. And so for the immediate effect, immediate interventions, I think they're going to have to be on the healthcare side. But nevertheless, longer term, there are some considerable challenges around the economy. I do agree with Ruchir's comments that the real stress is on smaller economies. But there used to be a very popular word back in the day, contagion. What are those risks of contagion? What might they look like? And even if they are not on the capital, on the financial side or the balance sheet, they may still be on the people and the disorderly migration, which you've already seen, not just from Africa, but across from the Middle East as well, specifically into Europe. So I think those are some knock-on effects that we have to look out for.
And this is literally a contagion. Chris Berry of House Mountain Partners in New York wants to put a question to Ruchir. And he's asking Ruchir if a US dollar shortage expedites or slows down the remaking of global supply chains.
Well, I think that a US dollar shortage is the biggest problem for emerging markets. So I think that in terms of the factors that I'm not sure how to link the supply chains with that, but clearly the single biggest problem in the world today is a dollar shortage, right? In a way for emerging markets, because we're all on a dollar standard. And this is one of the things I think that we again underappreciate just how powerful the dollar has become. In fact, as a financial superpower, the US has never been this powerful as it is today. Even though as an economic superpower, you can argue that it's not been increasing its share as much as it was in the 90s or something. But as a financial superpower, the US is extraordinarily powerful. So I think that what the emerging markets need more than anything else is a weaker dollar. But the link between supply chains and the US dollar, I'm not quite sure how to make that link. I think that those are two independent things which are going on.
Ruchir, Mohammed Al-Arian at Allianz has been saying that the stock markets have a sort of cognitive failure to recognize the scale and impact of the shock that's coming to the system. I see you're already smiling. I think he was referring mostly to the US stock market, but do you think he's right? Do you think the same holds true for emerging markets more globally?
Yeah, I think, like as far as the US is concerned, there's no, I think, doubt that liquidity is playing a big role in propping up asset prices. I think that's pretty apparent if the evidence you look. Now, what that means, I don't know, because of the fact of the matter is that is just a reality, right? Which is that with interest rates as close to where they are, close to zero, a lot of liquidity is finding its way into the stock market and into asset prices. But I do want to make a couple of points here about emerging markets. As I said at the beginning of your show here, which is that emerging markets today are still down 25% in dollar terms from the 2007-8 highs. And if you do a long-term trend line of emerging markets today, it is well below its long-term trend line as far as total returns are concerned. If you were to get back to the long-term trend line over the next 5 years, that would imply annualized returns of 15 to 20% a year in dollar terms for emerging markets.
Wow.
So that's my question, but or point rather, that things are really depressed in emerging markets already before we came into this, including in terms of its long-term trend line. The US stock market, all said and done, is at its long-term trend line. Because for the last 2 years, the US stock market really has remained flat. But emerging markets are so below their long-term trend line that if you were to return to trend over the next 5 years, that's 15 to 20% returns a year. So I think that things are very depressed to start with. I can argue that trend lines are broken, this is not going to work. But these are long-term trend lines going back many decades.
But Ruchir, isn't the market efficient in many respects? There's a reason that you haven't seen, I think, the rush back into emerging markets. And again, I'm quite sensitive to the term because I think it depends where you are. I mean, I'd be very interested as somebody who's from the emerging markets and keen to invest in that space. What sectors are you talking about? What specifically are you looking at that you think is depressed and actually has a very strong narrative to see an uptick in returns?
Yeah, so sure. So now, if you think, so if you make up a mind, are markets being efficient or not being efficient? Because if markets are being efficient, then the US stock, then the US stock market is perfectly right in terms of brushing aside the virus and being down less than 10%. So we can't have it both ways, that emerging markets are being efficient because they're pricing in a lot of the bad news and that's justified. And the US is being inefficient and prices that are really high compared to the pain out there. So I think that markets do what they have to do in terms of it. But we know that they go through cycles and they get over exuberant or they get overly pessimistic. So my thesis was that I've been very bearish on commodity prices. And I keep going back to what I was writing a decade ago, which is that that basically said that the commodity super cycle is over. And all these people extrapolating the commodities to do really well were going to be wrong about that. And technology was going to come back. Today, I think the opposite has happened, which is I think commodity prices are very depressed also compared to their long-term trend now. Things like oil and all are well below their long-term trend line in terms of it.
Ruchir, when you say long-term trend line, you're going pre-08 financial crisis.
Way back. For commodity prices, I'm talking 200 years here. I'm talking about oil basically going back over 100 years. I'm talking those kind of trend lines here that we were very extended a decade ago and now we're very depressed. So if you ask me about sectors and where I want to invest at this point in time, I think that I'm very intrigued by some of these, and there are some very quality companies in those sectors which are going a-begging today, even the consumer sectors. Like we know that in some of these emerging markets, people are going to consume more, people are going to buy more toothpaste or more cornflakes, or they're going to go and sort of, in terms of even consume more data. And we think that, things are very depressed out there, and you can get some really quality companies trading at a very cheap price because they've been so neglected. So this is about cycles. A decade ago, my view was exactly the opposite, and that was the thesis of breakout nations. Here we are a decade later, and I still don't write off the US. My latest essay was that this is a comeback nation, but the fact that things are so depressed in emerging markets that I wouldn't want to pile on the depression and the pessimism at this stage when things are so below their long-term trend line, including commodities. For the first time, I'm intrigued by prices here.
I had our new FP columnist, James Crabtree, write in with a question, and you've already answered it, which is, do you double down on what you said in Breakout Nations? And the answer is yes. I have time for one.
It's the opposite. I have to correct that. It's the opposite. In Breakout Nations, what I said was that the BRICS are really overhyped and that the US was the true comeback nation. That was the thesis of Breakout Nations. Yeah, there were some other countries I mentioned in the middle, saying that Indonesia, maybe Turkey, some of these could do okay. But the big takeaway was that the BRICS are overhyped, that term was, overhyped, and the US is the true breakout nation because of technology. That's how that book ended. Today, I've been saying I'm saying it's different. So I don't double down, but I think that it's a slight inversion from an investing perspective of what I believed a decade ago.
Fair enough. Trace held, this is our last viewer question from Indiana University. She's a professor there. Asks, this is to Dambisa, amid the financial trap for developing markets, should the world be concerned by China furthering its economic and geopolitical influence in Africa and in Central Asia? Dambisa?
Well, I think the issue really, and I, like Ruchir, 10 years ago, I had quite a different view. I wasn't really worried at all. In fact, I was very encouraging of the idea that emerging markets, African countries, South American countries should become more adult-like and finance their growth plans by tapping the capital markets. That was really part of the thesis of dead aid and other sources of capital, of course. Today, I'm much more sort of alert to the geopolitical schism that's emerging between the West and China, but more than that, also a bit concerned about what the sort of restructuring agreements are that come out when African countries or South American countries find themselves on the wrong side of China's balance sheet. So by that, I mean, they owe money to the Chinese. The Chinese have bought up a lot of debt in the secondary market. When in the past, when you had a bond or you had a obligation to the IMF, you'd simply restructure the loan, change your coupon, or extend the maturity. In today's world, with China, they're saying, well, we don't actually want to restructure it in that way. What we want is more access to your assets. And it may not be ownership of the underlying natural resources, but it may actually be buying the full stream of production that's coming from energy markets or from food or etc. So I do think that countries have been quite naive. It's not entirely obvious for many of these countries what they've done with the money that they borrowed in the first place. But quite apart from that, the issue is whether or not this type of a structural arrangement, essentially distressed buying by China, is putting countries in a better stead. And I think I do have some reservations about where we're landing in this respect.
Got it. Well, I'm afraid we're going to have to leave it there today. This has been a fascinating conversation. I want to thank our wonderful audience, hundreds of people from around the world who've joined us and who've been sending in our questions. Most of all, I want to thank our experts for giving us their time. Ruchir Sharma is in New Delhi, Dambisa Moyo is in Newport Beach, California. Thank you to both of you. A recording of this conversation will be up on foreignpolicy.com/live within the next hour. And don't forget, this call is just one of the many benefits you can get from being an FP Insider. Our latest special report is on data governance. It just went live this week. And of course, you'll find lots of news and analysis on our homepage, foreignpolicy.com. I'm Ravi Agrawal, Foreign Policy's Managing Editor. Stay safe, stay well. Thank you for joining. Thanks again to Ruchir and Dambisa.